Hey, badass business owners, welcome back to the show. Let me ask you a question. When was the last time that you worked so freaking hard and you were busting your butt? You knew you were making good money. You had some really good sales going on. But yet, for some reason, by the time you got to the end of the month, to the end of the quarter, to the end of the year, all of a sudden there was no money. And you were going, where on earth did the money go? Well, we all know that one of the reasons I talk about knowing your business numbers is so that you understand and know exactly where this money went. I can't tell you how many times I've looked at someone's profit and loss statement and that business owner did an amazing job with sales. We're talking like $250,000, $500,000, and the sales are just completely off the charts, and I'm so excited for them. And then I quickly scroll through and see where the money went, only to discover by the time I get to the bottom of that profit and loss statement, they made like $10,000. $250,000, $250,000, and they make $10,000 at the end of the day. Now, on one hand, I'm hoping and praying they were paying themselves as an employee in the business, so that way they made some money, because they're not going to live off of $10,000. But that is a crazy number to have at the end of those types of sales. And trust me, I know that. I used to do $250,000 in sales in my ice cream shop and have no money at the end of it. It is possible, and it is possible because of costs and expenses being much higher than what it is that you're selling. And when you have that problem, you just cannot make a profit. Sales are great and all, and a lot of people want to chase those sales. But look at it this way. If you're going to make only $10,000 at the end of the day, would you prefer to chase $250,000 or chase $50,000? Because $50,000 in sales with a $10,000 bottom line is a 20% profit, and that is awesome, and that is great. Versus someone who goes out and creates $250,000 and making that same amount of money. I promise you, unless they have a very high ticket, they are working way harder than the person who's doing 50. Now, I'm not encouraging you to do less sales. What I'm encouraging you is to understand your business numbers, so this way you can make each and every one of those sales count. Remember, this is not a sales game. This is a profit game. And I keep talking about this. And I want to pause for a minute. And I realize that we haven't talked about the profit and loss statement for a while. So that's what we're going to do in this particular episode. You hear me preach all the time about how you need to know the number one calculation. Say it with me. Sales minus cost of goods minus expenses equals profits. The reason that I teach you that is because that is the flow of money through your business. It is how you should be looking at your pricing. But guess what? It matches the profit and loss statement. If you capture and watch the flow of money through your business, through your P&L, doesn't it make sense for you to be able to understand that how this calculation impacts everything else? The reason is absolutely. Now, for some of you, you know exactly what a P&L is, or a profit and loss statement. For some of you, you may not know what that is. So give me 1 second to explain that. Sometimes it's called an income statement. Sometimes it's called a P&L, and sometimes it's called a profit statement or a business statement, your report card for your business. But on the actual form, it will say profit and loss income statement or income statement. If you are looking in your bookkeeping system that you currently use, for many of you, if you have somebody who does your bookkeeping for you, then they can print this profit and loss statement out for you. If you use QuickBooks Online or anything like that, you go into the report section and it'll come up profit and loss income statement. And for those of you just starting out who may not have a bookkeeping system, this is something that you can manually create if you have not signed up for a bookkeeping system. Now, I do encourage you to have a bookkeeping system. QuickBooks Online is my personal favorite, not a sponsor, but it allows you to be able to key things in, hook it up to the bank account, and track things really easily and change those categories and do what you need to do to be able to do it. And it allows this report to be printed for you. The only thing I have against it is it does not allow you to put the percentages on there, which I'm a huge fan on, which we will touch on here shortly. Now, when you're looking at your profit and loss statement, remember our formula: sales minus cost of goods minus expenses equals profits. The profit and loss statement is going to follow that exact same process. So your top part of your report is going to be your income. And now, some of us call it sales, some of us call it income, revenue. It'll say any of those things, but more than likely it's going to say income. But for your understanding, just know those are the sales you have in your business. All the sales that you take into your business go into that top section. For many of you, it's only going to have one line. It's just going to say sales. I'm a huge fan. By the way, when it comes to these profit and loss statements, they default to certain categories, and usually they are the most typical common categories. But you absolutely can put your own touch on everything inside of that profit and loss statement. So you can break anything you want down further, including sales. If you want to track sales by residential versus commercial, you can do that. If you have different types of sales, you can track them by each of those individual categories. When I had my ice cream shop, guess what? I tracked cups and cones. I tracked cakes so I could see what those did. And I tracked drinks and beverages, stuff like that, sundaes. I could break everything down if I wanted to because I'm a nerd when it comes to wanting to know where my sales are coming from. I broke it down a lot. It also allows you to be able to identify those categories to see if they're profitable on their own. So I'm a huge fan of that, but minimum standard is all of your sales go in there. Sometimes you'll have that secondary line if you give returns or give money back, because at the end of the day, what they count is how much money did you take in. So you're going to take out the money that you gave back type of thing. Now, your next section is going to be your cost of goods, sometimes referred to as COGS. So sometimes if you hear me say COGS, then I'm just referring to cost of goods sold. The important thing to remember about this section right here is this is all of the money that is spent to produce the product or create and deliver the service. If I make a product, so let's start with that. If I make a product, I'm going to have ingredients, I'm going to have materials, and I may have labor to assemble it. Great example is a bike. Let's just use that. Everybody knows what a bicycle is. If I order a bike and it comes to me already assembled, the only cost of good I have is for the bike. But if I have a bike business and I get all the parts of the bike and then I have to assemble the bike, then I'm going to have the costs of the parts and I'm going to have labor costs because somebody has to assemble that bike in order for me to turn around and resell it. So hopefully that makes sense. So if I make cakes, I'm going to have labors because I cannot give you that cake without somebody putting that cake together. However, if I buy widgets and I turn around and just resell those widgets, there is no labor involved. If I make candles and I make the candles, then I will have labor. If I just order the candles and turn around and sell them, there is no labor. So it's all about, do you need labor to assemble that product? It will be included in that. If you don't, then it's just the materials or ingredients for that particular item. When it comes to a service, the service is going to have any products that you might use. So for example, if you're installing bricks, you're going to have the cost of the bricks. If you're a handyman and you're installing ceiling fans and you purchase the ceiling fans are going to be in there. But when it comes to service-based businesses, there's going to be labor because that service cannot be provided without someone doing it. So if I clean carpets and my laborer is there for an hour and a half, then there's going to be an hour and a half of labor. If that handyman is installing that item and they're going to be at that home for an hour, there's going to be an hour of labor. Follow what I'm saying? Any other type of labor that is not involved in providing the service or creating the product is going to be an expense. That's in the next category of operational expense, because all other labor involved has to do with running the business, not in providing the service or product. So keep that in mind. A lot of times, especially when people are new and they start off, they do not have their labor under their cost of goods. And that's a huge mistake. And that's one of the reasons why it ends up costing you when you are pricing, because you're not including it in that section there. And that's one of the main reasons, for example, a business might do $250,000 with only $10,000 at the end of the day, because they're not doing it the right way. Or it can falsely let you think you're making all kinds of money, and the reality is you're not. You might say that you're doing $100,000 in sales, and yet you're making $10,000, and you're like, oh, look at all this money I made. And the reality is, no, you haven't paid yourself yet for being an employee in the business. Therefore, the business did not make that $10,000. You haven't paid yourself as the employee yet. And that's something that I do a lot of preaching about, and I'll continue to do more of these numbers on the podcast. I know on the YouTube channel with the videos, I've been doing it more and more. So I'm going to try to do it more here on the podcast as well. So sales, everything that comes into the business, cost of goods, anything that is spent to create or make the product, that's going to be your cost of goods section. there's another line that shows up, and we don't put it in our formula that we say with the sales minus cost of goods minus expenses equals profits. But there is a fifth section on the profit and loss that you will see next, which is called your gross margin. And all your gross margin is telling you is your sales minus your cost of goods. So your gross margin line, which is often called gross profit, by the way, so I don't want to confuse you. Sometimes it'll say gross profit, not gross margin, but it'll say one of the two. Your gross profit line, we'll call it that, since that's, I think, what the P&L says. Your gross profit line is just the difference between your sales and your cost of goods. And that's saying, hey, this is your profit after your cost of goods prior to your expenses and your profit line. But really what it's saying is this is the profit before you pay for your expenses, before you do retained earnings, before you pay your taxes, and before you pay the owner. And I'm going to get to that in a minute. So the gross profit line, all it is a simple line. It's a quick snapshot to say, hey, sales minus the cost of goods. Some people have a certain number in mind that they're looking for. They might be looking for 50%. They might be looking for 65%. They might be looking for 35%. Every business is different. If I don't have a lot of cost of goods, that number is going to be very high. However, if half of my money goes to my cost of goods, that number is going to be sitting at about half, if not more. Typically, you see that in service-based businesses that deal heavily with product and labor. If I'm installing backyards and I'm doing a lot of brickwork, then that's going to be a high cost of goods because I'm going to have a lot of money tied up in the brick and to the rest of the materials I have to use as well as the labor. They're going to have a much higher cost of goods than, say, somebody who buys candles already made and turns around and flips them because they have no labor costs and they just are paying for the actual product itself. So everything's going to be relative to your particular business. So when it comes to that gross profit line, you really just have to understand your business numbers, if that's a good number or a bad number. Now, the next big section is the operational expenses. Sometimes it'll just say expenses. Sometimes it says operational expenses. The big takeaway for that section is anything else that you spend money on in the business that is not related to creating or making the product or service goes under your operational expenses. There are two types of expenses that you have. Some are called fixed and some are variable. A fixed expense does not really change month to month. For example, if you rent space and you pay $500 a month, it's going to say $500 month after month after month. If you have something that's based off of sales and you don't always spend money on it, then that's going to go up and down. So sometimes, for example, if you have utilities, it's fixed, but it's also variable because you're going to probably have a minimum number that's going to be in there. But when you go into your season and you spend more, it might go up a little bit. There's some things that you will have that are fixed, but they don't show up every month because they're paid quarterly. Insurance sometimes will be done like on an annual basis, but it's more fixed because it's not changing all the time unless you have something that is based off of the number of employees that you have. Another variable one that can change month to month is maintenance and repair, kind of like your cars, your vehicles, stuff like that. The main thing that you want to keep in mind is when it comes to your expenses is, yes, you want to control your expenses because a lot of times this is going to be anywhere from 10% all the way up to 35%. Sometimes I've seen people at 50%. Most people are going to be between that 20 to 30%, I've noticed, is where most people fall. That doesn't make it right or wrong. It just depends upon what you have in that category. If I have rents and utilities and other high-end things, I'm going to be a little bit higher. But if I have very low overhead because I work out of my car and I don't really have a building and I don't have a lot of employees and it's just me, my expenses are typically going to be a lot lower because I'm not spending all of that money because I don't have office people running that up for labor side and things like that. So your expenses are going to be based off of your business. But the important thing to remember about your operational expenses is it all adds up. So if you're spending $50 a month on something you don't need, get rid of it because that's $500, $600 a year that could go to your bottom line. Expenses you want to run mean and lean on. But what you're looking for mainly with your expenses is things that are out of the ordinary. I'm a big fan of looking at your profit and loss, not just on a monthly basis, but I like that year-to-date number. I like looking at the years over year. The reason is things kind of mellow out. So for example, on maintenance, if you have a vehicle, you might have to put new tires on once a year. So you're going to have 1 month that's really crazy. But as long as the rest of the year, that category is ran very well, then you probably don't have a problem with that particular line. And I've seen people react and overreact. But where I care about, for example, is when you look at your advertising and your advertising is $500, $1,000 and you're not getting a return out of it. That one line alone drives me batty because I'm about spending money. I absolutely believe that you need to spend money on advertising if needed, because I think there's a lot of people that don't need to spend money on advertising. But what I'm a bigger proponent of is that you get your money back on that advertising. People just don't run the numbers and they don't look at the fact that their advertising line is running 5-6%, but at the end of the day, if your profitability is 10%, you have to do 10 times the amount of money you invested in that advertising just to break even. I did one the other day where they were going to spend $500, but the first $3,000 they sold was going to just break even on that advertising. So the first thing they have to do is ensure that they're going to get $3,000 of new sales, but then really that advertising has to bring in more than that $3,000 for that to even be profitable. Different fun thing, but these are the fun things you get to discover when you're looking into your profit and loss statement, which is why I'm huge at looking into it. Now, the final section is going to be your profit. That's going to be after from your sales minus your cost of goods minus your expenses equals that profit line, right? So at the bottom, it's going to have a profit line. But that line can be really deceiving because a lot of times people will go, oh my God, look at me, I made all this money. The business made that money. You didn't make that money, even though you did because you're the person behind the business. Don't get me wrong. But the business still has some more things it has to pay. So when you get to that profit line, the hidden message is some of it's going to go to taxes, probably about anywhere between 25 to 30% of it is going to go to taxes. Then you're going to have retained earnings, which is money you're going to reinvest back into the business to buy more product, more tools, that big equipment thing you need, whatever the case may be. Save up money for a rainy day. Make sure you have 3 months of emergency in case something happens. Those are retained earnings. And then there's going to be the owner's draw. That's where the owner's going to take some money out. So just because you see that $10,000 at the end of the day doesn't mean that whole $10,000 is yours. You've got different things that you need to spend on it. You want to be excited because you made that $10,000, but at the end of the day, you also want to be realistic that it's not $10,000 that you're putting in your pocket. I'm also a huge fan of percentages. And like I said, some of these bookkeeping ones will not let you do that. But you can manually do it and just chicken scratch it on the side. And this is why it's important that you do that. At minimum for the main categories with what they are. If every dollar in is 100%, right? Because all you can do is take in $1. And if we convert that to a percentage, it's 100%. Well, your cost of goods are going to be a certain amount of that. So for example, let's take a look let's just say that your cost of goods were 45%, your expenses were running 25%, and your profit is running 30%. I know this is very difficult to understand on a podcast episode, which is why, once again, make sure you're also going to the YouTube channel because I actually do visuals on all of this. And I'm going to link to several of the videos in the show notes, which will help you out because it'll show you this live. So make sure you do that as well. But if your cost of goods is 45%, think of it this way. For every dollar, you're going to take 45 cents and pay your cost of goods. And for every dollar, if your expenses are 25 cents, you're going to take a quarter and you're going to pay your expenses. And at the end of the day, when I take in my dollar and I've given 45 cents over here to COGS and I've given a quarter over here to the expenses, that means there's 30 cents, 3 dimes sitting in front of me. And of those 3 dimes, one of them's probably going to go to taxes, one of them's probably going to get reinvested, and one of them's probably going in my pocket. Hopefully that visual makes sense. I always like using the dollar and the coins because we can all relate to that. Now, when you think about your pricing, because once again, I always tell you sales minus cost of goods minus expenses equals profit. I want you to keep that in mind, not only for your P&L, but for your pricing. Because now when you set your prices, you now can say, let me manually go through this in my head to see if my money's going to go in the right way. So if I have a product or service that I sell for $50 and I know my cost of goods are running 45%, I can automatically know that $22.50 is going to have to be set aside to pay for these cost of goods, which, by the way, include my labor, if my labor is included in that. Then I've got 25% or $12.50 that I have to set aside for expenses. And by the way, it's the expenses that kick all of your butts, because a lot of times the money that you think you're making, you're basing it off of that gross profit, which is before your expenses and everything else, which is why you don't have any money, because you're forgetting that that money has to go to a bunch of other stuff. Now, if we got 30% profit, that means $15 is going to be set aside for profit, which we already know part of it's going to your taxes, your retained earnings, and your owner's draw. So if I go back to the very beginning, like I was just saying, when you do all those sales, what happens is we keep in mind what we have to pay in our cost of goods, because that's the most relevant, right? When we're pricing something, we think about our cost of goods. How much money am I going to have in these expenses and the labor and everything else? What we fail to account for is the rest of that money is going to those expenses, going to those taxes, and going towards those retained earnings or other things that we need to buy within the business going forward. Sometimes we have to invest it in more product or whatever the case may be. And then we're like, oh, wow, I don't have any money left over for me. That's right, because when you set your prices, you failed to account for the rest of that money in expenses and profit that you wanted to get. Because when you set your prices, you need to make sure that it covers your cost of goods, that it covers your expenses, and it covers the profitability that you need to have in the business. This is why it's so important that you understand your P&L, because your profit and loss statement, your P&L, is going to give you these percentages. It's going to tell you where you're spending your money, and it's going to allow you to be able to track where things are going. And like I said, take advantage, create subcategories. Advertising is a great one. If you're advertising in 3 different things, track those numbers separately if you want. I've seen people break out insurance into the different types of insurance that they pay. It's your P&L. You can do whatever you want to do and however you want it to look. Yes, a bookkeeper is not going to be happy that you're going to create these little categories and stuff like that. But once again, you're paying them to do you a job. And so many of them are collecting that $100 a month or a quarter or whatever it is that you're paying them. And they're just producing you something. Make sure you have clear expectations of what it is that you need from them. You want to have a dialogue with them to let them know what it is that you're trying to accomplish, and they should be working with you to be able to give you what it is that you need. And if they're just pushing back and fighting you and they don't want to do it, they're probably the wrong bookkeeper for you. I'm not telling you to go out and fire bookkeepers left and right, people. I'm just saying try to make a working relationship with your bookkeeper, because honestly, what you're paying them for is information, and they should be helping you get the information you need into the best way that they can do it. And in some cases, if you want to really dial in deep, you may have to transfer it over and export it into an Excel spreadsheet. But guess what? Your bookkeeper can actually do that for you as well. They can give you the PDF version, and they can export it into an Excel spreadsheet or a Google Sheet, and they can send that over to you as well. So you don't have to always do all of that. They can do some of that for you. I know this is a longer episode because I've touched on a lot to do with this profit and loss and how it ties into your pricing and everything else. My main mission is to get you thinking differently about the sales that you take in, because it's not a sales game, people. Yes, you need sales. Yes, you want to get to whatever sales number you want to have. I want you to have sales goals, but I want you to have profit goals just as much. And I want you to be just as passionate, if not more passionate, about the profit side of all of this. I don't want you to push for $250,000 in sales when $50,000 in sales will get you the exact same number. That's crazy for you to work tons of hours and do all of this stuff if you're not turning it into profit. And in so many cases, it's a pricing problem, because the pricing is not based off of the right numbers, and they're only based off of the cost of goods, and they're not including, like I said, those expenses, those taxes, those retained earnings, and that profitability you want to make. This is why I preach all the time that you need to make sure that you personally are in your P&L as an employee if you are doing employee work. Because if you are the employee in that business, you need to be paid as an employee for that time frame at a fair wage, not at $50 an hour. But if you would hire someone off the street at $15, $20 an hour, then that's how you need to be in that P&L as well. Even though you're writing yourself a check, you're not necessarily having a full-on payroll, but you need to account for the fact that, hey, I'm working 40 hours a week at $15 an hour, and I need to pay myself that as an employee in that business. At the end of the day, you're going to be taxed off of both of them, but your P&L needs to account for that, because if there comes a point in time when you need to hire an employee, if you're not pricing right, today to cover you as an employee, you're in for a rude awakening when all of a sudden you are not priced right yet and you hire an employee and then you wonder why your pricing is even more off and you're making even less money. Because one, when you hire that employee, that's money you're taking away from money that you normally would have kept because now you're paying it to somebody else. And if you weren't priced in the first place, guess whose money that's coming out of? Yours. Because you, the lucky employee in your business, if the business has no money, guess who's sacrificing their money? That's you. And the employee money that you were taking out of the business, which is why you wake up with even less money. It's a vicious cycle. That's why we want to make sure that you understand your business numbers. All right, I'm rattling. I'm going on and on. One thing I do want to let you know is I have started these P&L reviews where I just did the first one last week where I actually take a profit and loss. And instead of just teaching you the 4 categories, we actually look at it and see where the money went in the business and how they spent it and did it pay off. The one I just did, I show you how they spent all kinds of money on labor and payroll and getting themselves paid right, and how they did some amazing sales and how it impacted the bottom line. But did the gamble pay off? And the reality is you have to watch it to find out if the gamble paid off, because there's a couple things they did which are pretty amazing, and it really shot their sales through the roof. And you get to see what happened to the profitability, and more importantly, you can actually see the writing on the wall with what's going to happen in the coming year, which is actually the year we're in now. So check the links out below. I will make sure that to this video, to the basic P&L video will be in there. This way you can kind of get caught up, have a visual to what it is that we're talking about. And as always, I love the fact that you guys are with me on this podcast. And thank you so much for those of you guys that reach out to me. It really does make me happy and smile for the day when you guys tell me that you've been following the podcast and you find these episodes helpful. It really gets me going and fired up every Sunday when I sit down to do these podcast episodes. All right, with that, I'm going to get out of here because I know I keep talking, and I will talk to you on the next episode. Bye for now. Hey, badass business owner, before you go, as you know, I'm a huge believer in you knowing your business numbers. After all, it isn't about how much you sell, it's about what you keep. And the best way to grow your profits is to start diving in and understanding those business numbers. To help you on this journey, I have created the Know Your Business Numbers course. We will walk through how to read your profit and loss statement. You'll learn the key calculations that'll help ensure that you're making a healthy profit on all of your products or services, plus a ton of other good stuff that'll help you learn how to use those business numbers to create even more sales and profits. Just check out the link below in the show notes or visit knowyourbusinessnumberscourse.com. So if you're ready to increase those profits, it's time you start diving into your business numbers.